Behavioral finance is an emerging field that combines insights from psychology with conventional financial theories to explain why and how investors make decisions, often irrational ones, that affect market outcomes. Unlike traditional finance, which assumes that investors are rational actors seeking to maximize their utility, behavioral finance acknowledges that human emotions and cognitive biases can lead to unpredictable and sometimes suboptimal investment behaviors. Historical context and evolution. The roots of behavioral finance can be traced back to the works of economists and psychologists who began to challenge the efficient market hypothesis, EMH, in the mid-20th century. EMH posits that all available information is fully reflected in asset prices, implying that it is impossible to consistently achieve higher than average returns. However, anomalies such as stock market bubbles, crashes, and the irrational exuberance of investors suggested otherwise. In the 1970s, psychologists Daniel Kahneman and Amos Tversky pioneered the field of behavioral economics, which laid the foundation for behavioral finance. Their research introduced concepts such as prospect theory, which describes how people choose between probabilistic alternatives that involve risk, where the probabilities of outcomes are known. Their work highlighted that people value gains and losses differently, leading to decisions that deviate from rationality. Key concepts in behavioral finance. Cognitive biases. Overconfidence. Investors often overestimate their knowledge and ability to predict market movements, leading to excessive trading and risk-taking. Anchoring. The tendency to rely heavily on the first piece of information encountered, the anchor, when making decisions. For example, an investor might base their stock valuation on its past performance rather than its current fundamentals. Confirmation bias. The tendency to seek out information that confirms one's pre-existing beliefs and ignore contradictory evidence, which can lead to poor investment decisions. Regret aversion. The fear of making a decision that could lead to regret often causes investors to avoid taking action, even when it is in their best interest. Heuristics. Representativeness. Investors may overestimate the similarity of current situations to past events, leading to misguided decisions. For example, they might assume that a company's recent good performance will continue indefinitely. Availability. Decisions are often influenced by information that is most readily available or recent, rather than all relevant data. Prospect theory. Developed by Kahneman and Tversky, prospect theory describes how people make choices in situations of risk. It suggests that individuals are loss-averse. They experience the pain of a loss more intensely than the pleasure of a gain of the same size. This can lead to irrational financial behavior, such as holding on to losing investments for too long to avoid realizing a loss. Implications for investors and markets. Behavioral finance has significant implications for both individual investors and the broader financial markets. By understanding the psychological factors that influence decision-making, investors can improve their strategies and potentially enhance their returns. Here are a few ways in which behavioral finance impacts investment practices. Portfolio management. Awareness of biases can help investors make more rational decisions. For example, recognizing overconfidence can lead to more cautious and diversified portfolio choices. Market anomalies. Behavioral finance provides explanations for various market anomalies, such as bubbles and crashes, which cannot be adequately explained by traditional theories. Investment strategies. Behavioral insights can inform the development of investment strategies that exploit the predictable patterns of irrational behavior in markets. For example, contrarian strategies that go against prevailing market trends can capitalize on the tendency of investors to overreact to news. Financial planning. Advisors can use behavioral finance principles to better understand their clients' needs and behaviors, helping them to create more effective and personalized financial plans. Criticisms and limitations. While behavioral finance offers valuable insights, it is not without its criticisms. Some argue that it lacks a unified theoretical framework, making it difficult to apply consistently. Others point out that while behavioral finance explains why people make irrational decisions, it does not always provide clear guidance on how to correct these behaviors. Moreover, the field is often seen as a complement rather than a replacement for traditional finance theories. While behavioral finance can explain certain anomalies and offer strategies for dealing with irrational behavior, traditional financial principles remain fundamental to understanding market mechanics and investment practices. Behavioral finance has revolutionized the way we understand financial decision-making by integrating psychological insights into economic models. It acknowledges that investors are not always rational and that their decisions are influenced by a complex interplay of cognitive biases and emotions. By understanding these factors, both individual investors and financial professionals can make better informed decisions, potentially leading to improved investment outcomes. Behavioral finance has profoundly reshaped our understanding of financial decision-making by highlighting the psychological underpinnings that drive investor behavior. Unlike traditional finance, which assumes rational actors and efficient markets, behavioral finance recognizes that cognitive biases, emotions, and heuristics can lead to irrational and often suboptimal investment decisions. The field has provided valuable frameworks and concepts, such as prospect theory and various cognitive biases, that explain why investors frequently deviate from rationality. By incorporating these insights, investors and financial professionals can better anticipate market anomalies, manage risks, and devise strategies that take human behavior into account. Despite its contributions, behavioral finance is not without its criticisms. It lacks a unified theoretical framework and does not always offer concrete solutions for correcting irrational behavior. Nonetheless, it serves as a crucial complement to traditional financial theories, providing a more comprehensive understanding of market dynamics. In practical terms, awareness of behavioral finance principles can lead to more effective financial planning, improved portfolio management, and better market strategies. Behavioral finance has transformed our understanding of financial decision-making by integrating psychological insights into traditional economic models. It reveals that cognitive biases, emotions, and heuristics often lead to irrational investment behaviors. While not replacing traditional finance, behavioral finance complements it by explaining market anomalies and guiding more informed investment strategies. By recognizing these psychological factors, investors and financial professionals can make better decisions, enhancing their ability to navigate complex financial landscapes. Thank you for joining us on this financial journey. We hope today's insights have added value to your financial literacy. Remember, financial success is a journey, not a destination. If you enjoyed today's content, don't forget to hit the like button, share with your friends, and subscribe for more insightful videos.